Welcome to Property Perspectives. Join me. I'm your host, J.G Kemp, as we embark on an exciting journey through the world of real estate and life. Each week we explore property ownership, investment strategies, and their impact on our daily lives. Get ready for an exhilarating ride and fresh insight and fun discoveries together. And this week we have a great guest, Neil Caron with CMG Mortgage.
CMG Mortgage.
All right, you want to introduce yourself?
Yeah, so I'm Neil Caron. I work for CMG Home Loans. I've actually been in the business. This is my 25th year. Jay and I were just reminiscing about that.
Yeah, that's great.
Jay and I know each other.
Yes, we do.
You want to talk a little about that?
Yeah, sure. Why not, man? That's why I got you here. So me and Neil been to elementary school. We've known each other since elementary school. And it's just wild that now that we're in the same business, right? And I known you for doing mortgages for a long time, right? 25 years. So I've been doing this for 21 years. And when I came in, I heard Neil was doing mortgages, and he was kicking butt, right? And still here today, kicking butt.
Still here today.
Looking good.
You as well, my friend. And it was funny because I always got a kick out of watching people interact years later with each other in the business and reminiscing about the stories. And I remember thinking, man, I don't think I'm ever going to be there. And now here we are, like the old dudes.
I know, right? I know.
In the room.
It is crazy because we were just talking how the average mortgage real estate agent are in their 50s.
Yeah.
When they come, it's a hard business to come in and conquer.
Yeah.
Right? Because you have to go to the island and send the ships home. Mm-hmm. This has to be a lifestyle.
Oh yeah.
And it's hard to pay your bills when you have to wait on a check that might take 6 to 8 weeks. Mm-hmm. Right? Or longer.
Yeah, it's not for everybody, right? I mean, when I got in, and we were just talking about this, when I got in 99, I didn't even know what originator was or what a realtor really did.
Right.
And it was something that I found myself exposed to very unexpectedly. I was actually on a law enforcement track. My whole family, my father was a chief of police.
Yeah. That's crazy.
Yeah, my brother's a police officer in New York City. I thought that's the way I was headed. My aunt's a judge.
Right.
And the world kind of finds you in some weird places. I saw an ad for loan officer assistant, and in 99 I walked into Savings Bank of Manchester where I think we all had our first passbook.
I know, that's all.
And I became a loan officer, and I was actually our assistant. I was brewing coffee and doing faxes, and I didn't even really own a suit. And fast forward 25 years, I'm in Connecticut with a team all over the state, and
all over the state. All right. So Savings Bank of Manchester, was it the one on Main Street?
Yes.
That one that was like the little small building with the drive-through?
Yes.
Oh, that's great.
Yes.
That's great. And they did a lot of loans.
They did a lot of loans.
Who would have knew Manchester would be like a big, trendy town, right? Mm-hmm. I mean, we were there when there was like no Buckley Mall.
I just read this morning in Connecticut Insider, I think it's called, or East of the River News, on one of the blogs I get or the emails I get, that Manchester is designating itself some kind of that's what I'm looking for, not historic area, but it basically like arts and entertainment, and they're trying to give themselves a national designation, which will open up a whole bunch of doors for them and start to make it more of a cultural.
And you see it coming.
Yeah.
And you see it coming. I would have never knew.
Nope.
There's a lot of farmland and stuff like that. So you've seen an ad in the paper, a loan originator. Mm-hmm. Take us along that journey when you first got your first loan. Stuff like that. How did that feel? Yeah,
so I was the new guy, the new kid, and when I came into the business, it was very territorial then. So what would happen is a new loan officer coming in, it wasn't like today. In fact, I didn't have a cell phone. So in 99, it was a pager.
I know.
This is really.
They had the cell phones, the big ones. From Radio Shack.
100%. And I don't even want to watch this video back at the end because I'm really dating myself. But I had a pager. So you had a pager and you were given a territory. Ironically, I'm back full circle. My territory, when I got off I'll tell you another story in a second. When I got off the highway, I was Hartford, Wethersfield, Newington was my territory. Okay. And when I got assigned to that, I was the new kid. I had a suit that barely fit. I showed up at an originator meeting. And they said, hey, this is our new LO. He's been brewing coffee and doing stuff for 6 months for us. He wants to take a stab at it. I think they were going to pay me $500 a week. And I remember thinking, my God, I'm making $500 a week. This is going to be amazing. And you had 8 weeks. You went back to your point. You had 8 weeks to make it happen. Right. And then you went on to full commission.
Full commission.
That was it. So you got $500 a week and a little expense account and a pager, and go for it.
Go for it.
So I went out Hartford. When I got assigned Hartford, everybody at the table just kind of went, oof. Mm-hmm. Like, this dude's got the short straw. Like, he's got a... And it turned out to be the most magical experience for me, because I ended up in an underserved area that I didn't know.
Absolutely.
I didn't know they were underserved. I kind of show up, this little kid from Manchester, and I'm like, hey, I'm going to write loans, and here's my sales pitch. Right. Give me all your good loans. Right. I would go to real estate offices, and they would almost think I was joking because I had no pitch. It would be like, I'm here, and I'm Neil, and give me your good stuff.
Right.
And that grew. And over 5 years, I was doing everything in Wethersfield and Hartford. You mentioned Kirk Clemens Sr.
Oh, yeah.
God rest his...
Oh, yeah, that's what I heard.
Yeah, he passed away.
I just heard. Was that pretty recent?
Yeah, in the last year, I think.
Yeah, I just heard that the other day.
He gave me my start. So he actually...
Really?
Yeah, he actually said, hey, kid, come on in, and I'm going to introduce you to my realtors, and they seem to like you, and we're going to make you part of...
for you.
Yep, and for the probably 5-10 years, everything I did was down in this area.
Wow.
Yeah.
That's interesting.
Yeah.
And it's funny because we spoke about this, Hartford, right? You bring that name up, a lot of people are like, ooh, right? Get a lot of loyal customers coming out here.
Yeah.
A lot of loyal customers coming, a lot of investors.
Yep.
So you turn one deal into multiple deals, right? So what did your first deal look like? Was it a single family home?
I don't remember it specifically, but I remember my typical client at the time was something I wasn't prepared for, right? At that time, and still today, large Hispanic population. Mm-hmm. I spoke no Spanish. Mm-hmm. I didn't look Spanish. I had no ties to, I had no ties to the market. And it just evolved with me. I ended up with an assistant that was Spanish speaking, and she was Hispanic.
Smart.
And that happened very quickly. And then we just figured out what the community needed. I spent a lot of time. My days were working with different organizations in Hartford, like the Urban League.
Yes.
Yep. House Hartford. And I found
still around too.
Yeah. And I found myself spending a lot of time there, and that's how my base built. And one loan turned into 2, turned into 10. Mm-hmm. And they were small. The one thing I do remember, they were all FHA. CHFA for all first-time home buyers. But I would write one loan for a family, and then I would do 3 more.
Got it.
So that was really the kind of the secret of my success.
Mm-hmm. And a lot of long days.
A lot of
long days. What does an average day look for you now?
Well, man, we've come full circle. So I used to work, I used to get up at 5, 6, do my family stuff, and I'd be home 8 o'clock at night, right? So they were big days because I was out. And then still, after I put the kids down, I'd be on the computer and doing my thing. And then life got easier. You figure things out. You get a few employees. Life kind of grows, and you get more responsibility, and you've got more staff. And then a collapse starts to happen again, and you get real comfortable, and then you go through cycles, right, where you're working hard, and then you kind of relax for a bit, and you get comfortable, and that's dangerous.
Very dangerous, especially in this field.
Yeah, and I think it's I call it neurotic selling, right? We go out, we do all the right things. We get the customers, we do the advertising, we meet all the people, we blow our business up, and then we forget how to do all that stuff.
Right, and that's a funny thing, right? We were just talking about this, because 4 years ago, for most people, 2020, you didn't have to do much to get a deal or close a deal.
No.
You could do less deals than you did the year before and still make more money.
That's right.
Right? And we've been through a lot of markets, right? This is the first time that I've seen, in the 21 years that I've been doing this, prices consistently go up so much, inventory staying consistently low, quote unquote, and but more people holding on to their property.
Yeah, we've got something. We have a culmination of things that we've never seen before. So historically, if you go back 30 years of measured mortgages, and if you look at the mortgage market kind of side by side with the real estate market, we all know the old adage, right? If rates go up, property values usually come down.
Right.
And if property values start to go up, rates usually follow. And it just really followed a purchasing. As rates went down, people could buy more. We have the exact opposite happening right now.
Okay.
We have rates, I don't want to say artificially being raised, but the Fed is raising rates and trying to use it as a tool to control the economy, and to the best that they know how. So as you remember, through the roaring early 2000s, we'll call it, the Fed would drop the interest rate down. It would spur housing activity. And we really have a system in the United States where our wealth is really propped up on real estate. At the end of the day, if you look at it, we define who we are by home ownership, where we live. We strive to buy a home. That's the ultimate goal, or was the ultimate goal for a while of your life.
That's true.
So what's happened now is the Fed's at a little bit of an impasse, right? So they're raising rates, but property values aren't coming down.
They're not.
And the reason they're not coming down, there's a whole host of reasons. So the biggest reasons are, number one, we have the millennials, who we actually thought were on the sideline forever and really weren't moving. They got started a little bit later. It's kind of a buzzword we all use, millennial home buyer. But the millennials got started into their 30s, deciding that they were going to buy a house. And it also coincided with the pandemic. So we had people at home. Yeah. And it was a perfect storm. And then rates dropped. The Fed thought the pandemic was going to be such a problem that they had artificially dropped the interest rates very low to keep the economy going. And it had that effect. The roaring 2020 and 2021, where the mortgage business, we did $4 trillion, about $4 trillion in mortgage. It was almost 3-4 times what we'd ever seen. And that happened in 2 years. But what happened was it forced people to move to areas that they'd never been to. We had no foreclosures happening.
Yeah, there's hardly.
There's none.
Yeah, right.
We had people cash rich, saving money, savings accounts are paying. So everybody feels really good and rates are low. So they're buying everything. And what happens is the pandemic's over. The party kind of stops a little bit. And the Fed says, hey, we're going to try to cool this down because we see inflation coming. So we see a possible recession on the horizon. So we're going to tweak rates up a little bit, see if we can slow this thing down. And it doesn't happen. So they start bringing rates up. And then what happens is an unintended consequence, which is people that are in their homes have nice low payments. They're very comfortable where they are.
Boom.
And they don't want to leave.
They want to leave.
Right. And they keep waiting because even if they sell right now, they're only going to go out and have to buy something. It used to be you could trade off, right? So it used to be if I sell right now, I can just go get an equal property somewhere else. Now the problem is that rate's at 7%. So you have a rate of 3, you're not going to be able to afford that much anymore.
No, right.
So to recap, we've got low rates and people in their houses. We've got foreclosures non-existent. We've got, the rates at an all-time high are keeping people kind of stuck where they are. Good news, if there is any to that, we'll just spin on it quick, is we're entering a period in 2024 where you have to think about some things. People eventually have to move. It's going to happen, right? At the end of the day, you can hold out as long as you want. Like we've heard stories of couples not getting divorced, right? That are living separate lives in their houses, but can't afford to get rid of the house. And can't afford to walk into separate interest rates and separate. So you're going to eventually have this is going to happen. It's inevitable. You're going to have, number one, people have to relocate. Jobs are going to take them around, especially right now. How the job economy market's kind of tightening up. We're hearing about people losing jobs and layoffs happening. People are going to have to move, so they're going to relocate. 2, people unfortunately are going to die, pass away.
We're in the baby boomers.
We can't control that.
Yeah.
You're going to have people that do get divorced. You're going to have people that, for whatever reason, have to fly the coop and take a job so there's going to be a whole host of foreclosures. They're going to happen.
They're going to happen. I'm starting to see a lot more come up on the pre-foreclosure list as of lately.
Yes.
I'm starting to definitely notice that. And it's funny you should say people are going to have to to die because 67% of the wealth in America are held
Right.
by the baby boomers.
And I don't want them to die.
No, we don't want. Well,
But it's
no,
gonna-
we
but it's
don't.
gonna happen.
We don't. We don't. We don't want anybody to die. We want to live forever.
I don't want that to be the reason the housing market.
No, I know.
Don't focus on that.
I know. They would be like ambulance chasers, right?
Yes.
Right. So, what do you think about the first-time homeowners? This, like you said, there's still a lot of people out here looking to buy homes.
Yes.
That's how you started, and I'm starting to see a lot of programs, unlike some of the programs we're seeing in 06, 07, 08. No doc, no job history, just purely credit score. They got rid of the subprime. Now you're seeing like 100%, 110% down payment assistance.
Yep.
Different type of programs. Yeah, I almost feel like they're the ones carrying the market right now.
Absolutely. First-time home buyers represented the majority of the activity that we had in
Right.
2023.
Right.
So to put in perspective, for when we peak in 2021, we do that. And again, these numbers are pretty close. We do $4 trillion in new loans.
Mhm.
That number drops down in 2023 to $1 trillion.
Wow.
So to put in perspective,
That's a lot.
Oh, it's a lot. So now remember, we're also at a super peak that we never saw,
Right.
but now we're at a super low
Right.
that we've never seen either. So there's been no common ground in the middle.
Mhm.
First-time home buyers in 2023 represented, and I'm going to talk a little bit Connecticut specific also because Connecticut incentivizes some things, but Connecticut did a really good job by the first-time home buyer. They did right by that person that wanted to promote home ownership.
Mhm.
They came out with time to own.
Time to own, which kept running out of money.
Kept running out of money. Actually, I was part of that. I actually did a presentation and I testified in front of the housing committee.
Oh, really?
Yep. Because they weren't. It's not my doing. It's just they were pushing to refund it. I don't think they understood how much of an impact it was having. Meaning keeping
I was
things
having a
rolling.
big impact. Yeah.
I spoke for about 5 or 10 minutes on a slotted time where we discussed all the reasons that it was important to fund it. At that time, a year and a half ago, time to own was basically here's $50 million, and when it's gone, it's gone. And we had to go back, and it was an emergency session almost.
I remember that. It was probably, I think it was around like a December, January.
That's right.
Yeah.
Heading into the new year.
Yeah.
And then it was approved, but then the funds weren't released, and it took a couple weeks. In Connecticut, I got to tell you, there's a young lady that I work with over there at CHFA. Her name is Lisa Hensley. She was brought up from, I believe, Washington, D.C. is where she's from, Maryland there, maybe Washington, D.C. And she's doing an unbelievable job just getting in there and getting in the weeds with us on the street and making things happen. Time to own, for those of you who don't know, I'm going to talk about it for
Sure, please.
So,
let the people know.
yeah, so time to own is essentially if you're a first-time home buyer in Connecticut, you can get a grant up to $50,000.
Right, depending on where it's at.
Yep. So high-income areas are $50,000. On average, our borrowers get $25,000, and that can be used towards the down payment, the closing costs. It also helps them get into a conventional loan with CHFA versus an FHA. A lot of people don't pay attention to this. Is that once you have that money, it's not 3.5%. A lot of time that money shakes out to be 5% or 10% of the purchase price, and we can then put them in a conventional loan.
Okay.
They can end up with cheaper mortgage insurance. They can end up with MI that goes away. So there's been a lot of benefits to that program. It's also helping them qualify. So you introduce another $50,000 or $25,000 into the equation, that brings their debt to income ratios down, and it's giving us the ability to make them competitive in this market. Last month, I think 70%, maybe more, 80% of our originations at CMG for Connecticut were CHFA.
Really?
Yeah.
CHFA is doing a lot of business right now.
Yep.
Connecticut Housing Financing Association.
Yep.
Right. Doing a lot of business right now. I'm seeing a lot of loans coming through them. A lot of down payment assistance. So I guess that's here to stay for a while. How much money they got left?
So now it's renewable. We'll call it automatically renewing. I don't know the exact number. I'm again 25, 50 million. What happens now is there doesn't have to be an emergency session. They've actually built it in that every year it will refund itself.
Okay.
So those funds will be there. So right now, maybe we have to go back and get more if it runs out, but it's not, it's gone. It's continuing to fund. something interesting with time to own that I learned, which just recently, is time to own also, we've come to know it as the grant program. Time to own is actually an entire initiative, or which I should say, it's an initiative for CHFA that encompasses a whole bunch of different things. Very shortly, they're going to be launching programs that will be piloting some to do with ITIN loans, renovation, construction,
like 2 or 3,
manufactured housing. So there's time to own kind of got segmented into the DAP side, but we're going to start to see there's other releases that are going to happen that are going to push different avenues.
Rightfully so, right? Because not everybody is a first-time homeowner.
Correct.
They want to buy different types of homes, which leads me to my next question. What other type of loans do you do?
So CMG, who I work for, is a full-service lender, one of the largest lenders nationally. When I say full service, we service the majority of the loans that we originate. So a customer that starts with us, in my opinion, it's better for me and for our team because they're with us what we call cradle to grave, meaning from the moment we originate the loan and underwrite it and process it, and then when it closes, it goes into our portfolio. Right. So that customer continues to pay CMG back, which makes it a little easier for us. If they have a problem, we're not gone.
Oh, okay, so you don't just go sold the loan to a secondary market?
No, there are some products that do get sold, and I don't know specifically what's involved in that. From time to time, a loan can get sold, but the majority of our loans are retained by us.
Got it.
Which has saved us and a lot of mortgage companies. Servicing of loans is what really rose to prominence during the last 2 years. As a servicer, you receive income as the money comes in. So as originations have really dropped off, in some examples, 70% in some markets, servicing revenue allows you to continue and survive and pay the bills. And our company's done a really, really great job.
It's interesting you say that because we've been doing this for a while. I remember companies used to send off the origination to a whole separate, different branch. But the trend is now to almost have it in office. Yeah,
there's an argument for both. There's an argument for brokering versus banking. There's an argument for servicing versus not. There's sub-servicing. But the reality of what we will call 2023 and into 2024 is the servicers are really emerging as the ones that are in a much better position.
Got it. I'm glad I got you here, right? Because I always say to people, I could find you a house, right? It's not a problem. That's what I do. But if you don't have the money, you can't buy the house, right? And I always say you should, even if you don't think you're ready, but you're thinking about it, you should align yourself with a great mortgager because they're going to give you a roadmap on what you need to do if you need to do anything in order to accomplish your goals, right?
Yes.
All right, so that's where you come into play, right? So where do you see 2024 taking us?
Oh, man. Yeah, this would be if I could only answer this one with 100% accurate.
Wow, yeah. You're rich off on an island somewhere.
Yeah. So what do I think? So, and again, I will give the disclaimer of this is my opinion only, and it's not to necessarily reflect the opinions of CMG Mortgage or of Five Star Real Estate. So, I think that we will see, and this is where I get my data from. So I'm a big data guy. I read every morning. I like to look at all the reports, everything that comes in from the MBA, Mortgage Bankers Association, NAR. You're right. I look at all of the Connecticut reporting. I pay attention to a couple of reports. One's called the Chrisman Report. I really follow that closely. I think we've hit somewhat of the bottom, and what I mean by that is I don't think there's going to be any catastrophic collapse. I don't really know how that would happen in any scenario, because if we have a large deposit of inventory that all of a sudden appears, there's a large amount of buyers that want to buy.
Ridiculous.
So that doesn't concern me. Like the idea that we'll end up in a crisis like 08, I don't see. 08 was a crisis of mortgages where loans were written to people that shouldn't have them. They couldn't afford them.
Right.
And then banks didn't know how to deal with it and lenders didn't know how to deal with it. So we threw everybody out of their houses. Well, as we learned, that doesn't work. So we don't want to do or see that again.
Okay.
So ultimately, as we head into 04, I think foreclosures are going to come back. It's already starting, which is going to introduce some more inventory to the market. I think it's going to be a little while before we see a normalizing of prices.
Right.
I think we'll be up in transactions 20%, but I think that's also going to not affect you as much because I think that'll be a lot of refinance activity in there, which obviously healthy for us, not necessarily to a realtor. But I also think we're going to see rates settle in. If I had to give my big prediction, and we'll have, I'll come back in 6 months and we'll see how it shook out. I think rates will probably settle around 6%.
So where are we at now?
So right now we're about 7. The national average as of this morning was about 6.875%.
Got it.
And that's a real number.
Got it.
So we'll call it 7. The only doomsday scenario I see is, so I'll give you, that's what I think 78% is my percentage on that. I think 80%, we increase a little bit. I think things flatten out. I think we see some inventory. I think the market will remain competitive. I do. I don't think that's going to change. If rates drop down to 4% or 3%, I don't know how that helps us, right? So everybody keeps putting all this pressure on interest rates. But imagine if we drop rates to 4%, that just blows us right back up, and you can't do it.
Right.
So I think what's going to happen is we're just going to normalize this year. Worst case, we hate to use the word, but the recession word, the inflation word, if things continue like they are, we're still inching up a little here. Inflation's still, we all know it's expensive at the grocery store.
Oh my God.
We're all thinking about a little bit, at least I am, what we're spending right now. It's not 2 years ago.
I know I am.
Yep.
I'm a little cheap though.
The Fed could react the other way. Like they could not drop the rates, and they could say, hey, look, inflation is creeping up and we need to get it under control. We're going to keep bringing the rates up.
So for all the people in the audience who don't really know how that works, maybe you can explain a little bit. So with the inflation being high, core inflation, right? In order for the Feds to get under control, they will higher the interest rates, right?
Yeah. So, we're really, really dumbing it down, but we'll just use this as a lever and a correlation. So what happens is when the Fed for years has used interest rates as a way, and when we talk interest rates, we really mean like they adjust that prime rate up and down, or the Fed funds rate. They've been using that as a lever for, in my career, left 25 years. Started with Greenspan, who lowered rates. And
Greenspan.
Yeah.
I
remember that name, Alan? Big G.
Yeah, oh my God.
There was actually a Greenspan watch. You could bet on Greenspan. It was, based on the tie he was wearing. What was he going to do?
Yeah.
Well, Greenspan lowered the rates for so long that we ended up in this kind of artificial world that we're in now. It's not his fault. It's just checks and balances weren't put in place. So what happens is the Fed uses that rate to kind of control, for better or worse, the economy. And for the last 25 years, it's kind of worked. When they lower rates, things speed up. When they raise rates, things fall off and slow down. And it's really worked. They've really dialed it in until the last couple of years, where because we had such activity, my personal opinion, I think we screwed it up a little bit. I think with dropping the interest rates during COVID was a knee-jerk reaction. We thought we had to do it. We thought the world was going to fall apart. We pumped all this PPP money into the economy, and it really made things look great, and maybe they weren't. We're just seeing the end of that right now. Credit card debt is creeping up, and inflation is happening because there's a lot of money. All that PPP money was put out in the market. So what's happening now is the Fed's just trying to figure out what's going to happen over there, and they're trying to take a calm approach. I think if they let things go right now, I think we're starting fresh. I think we're at a good base right now, and let's see what happens.
Yeah. So what I'm seeing on the listing side, let's just say first-time homeowners, right? We'll just talk first-time homeowners getting into the market. First time a starter home is ringing around 350, 400 right now.
Can you imagine?
I think our median is like 380, 429. I think our median is.
Yeah. What is that? You're seeing, what's that look like? What's a $350,000 starter home look like?
Oh my! So 350,000. It's a regular home, bro. It's a regular home. So in Hartford, let's just say Hartford. Yeah, they're creeping up there too. They're getting around to be 300,000 too. They'll start in at like, let's say 250, 275.
Yes.
By the time it's over, it's 300, right? Just sold a house in East Hartford. Starter home, 6-room, 3-bedroom, 1-bath, Cape. Typical, right? Real nicely priced, $250, right? Ended up at around $275.
Yeah, it's wild.
At $275, it's going to end up around $300. You put that in West Hartford. Last year it was about $275. Right now it's about $315. They're ending up around $350, $375.
Yeah, I remember seeing the pictures of people like lined up around the block, right? Too, like down the road.
Oh my God, yes. And I can imagine on your end, because you get all these buyers that are pre-qualified, then they can't get a home.
Yeah, we just Madhu, my assistant, my associate, we just talked about this last week. He said, "Man, I just had something happen that's never happened. We just had 3 of our pre-qualified buyers, all bidding on the same house." Now that in and of itself isn't super strange, because we remember back in the day, 5 years ago, if you had 2 buyers bidding on the same house, you would go, "Hey, at least we know we're going to get one of these mortgages." Right. We just had 3 or 4.
Oh yeah, I see what
and we didn't get any of them.
Any of them.
So that's a reality.
Yeah, it is a reality.
That's a reality.
Yeah, so we're around 687. You said right now. You said today.
Yep.
Historically, where were we at? Let's say when you started till now.
Yeah. So, it's funny. I do get into this debate with people. So when I started in 1999, the interest rate was around 8%, and it had just gone to 7.25%. And people were doing cartwheels in the street. They couldn't believe it. This was the cheap, because rates were coming off at that time. They've been as high as, I think, 17, 18%.
Oh yeah, I've heard that before.
Yeah. So those are a reality.
Right.
So at 7.25%, 8%, we haven't even really gone full circle yet.
I know. Imagine if we go back to that.
Correct. But the problem is, my first house that I bought was $68,000. It was a Cape on Devon Drive in Manchester.
Oh yeah, $68,000.
And the realtor was sitting on the step when I pulled up. I was 21 years old.
Who'd you use?
Nothing. His name was Roger. I think it was Roger Dock was his name.
Not around.
I don't think he's even around anymore. And he was sitting on the step, and I pulled up, and he was so excited, because these open houses would happen and nobody would be there. Right. Like there was 1 million houses on the market.
Right.
I mean, we don't even know what that's like today.
No,
like that's
not at all.
And we did the deal. My rate was 7.25%. I was able to get a mortgage as a 21-year-old kid. I sold my Jeep CJ7. I bought the house. Yeah. The guy that helped me was, that little did I know that was probably my intro into the mortgage business. Right. He couldn't believe I was doing it. And I kept that house. But different than what's happening today is that house kept appreciating fast, right? I sold it a couple of years later. Rates were now 4%. Mm-hmm. And I think that was where we hung out. I think, that was if I had to guess, 4% has been about the average for the last 20 years until today. We're in a little bit of a vacuum too. I'll throw this at you. Hartford specifically and New Haven, they make a national list the last 6 months as the highest appreciated areas in the United States.
All right. So if you can elaborate on that a little bit.
So it is more unaffordable to buy a home in Hartford and in New Haven than 95% of America. So I think Hartford was number 2 or number 1 in New Haven, and mixed in with, that's everybody. That's California to here, and I couldn't believe it when I saw the stat.
What?
Yeah, I'll send it to you. It's pretty wild.
It's funny you should say that, right? We were just talking about how home prices have constantly risen in the last 3-4 years. I've never seen them constantly rise this much in such a short time span, right? I got a mastermind group that I'm in on every Saturday, right? Because I'm a Mike Fury agent, and I need that accountability. And they put me in the hot seat. And without going into numbers too much, one guy basically said he made a little over $150,000, 16 transactions, been in the business for 2 years, right? I do a lot of volume, right? And I'm not afraid to say it. In our market, my commissions at that volume when I'm selling, my medians are probably about, let's say, 2.25, 250 on the average, right? They're starting to rise a little bit. These guys' medians in California, like 550, 600,000.
Yeah.
Right? So that's their first time home.
Yes.
And everything's trendy. So let us go back now to you say that Hartford and New Haven are the least affordable places.
Yeah, and that's just an easier way to put it. It just means we have the most rapidly increasing year over year property values.
So I'm going to get to my point. So I just brought this up a few weeks ago on a few more podcasts, so you can check the records. So as you start to go up 95 to 91, you get the New Yorkers that are coming in, and they're raising the prices in Fairfield County, and they just gradually go up. We kind of are a little slower because we're on 84 and 91. So we get a different type of person that comes in. They don't really come up as far, but still rises. And this is what's changing. So I was saying a few weeks back, I'm noticing 3 families, Fairfield County, 600, 650 for 3 family, right? And New Haven, I noticed they're starting to be around that figure, 550, 600. And now they're starting to get comparables. You need a comp now I can actually sell, right? I just seen a 3 family in the West End, Hartford, I think this morning, for $515,000.
Yeah, it's wild. We're in a little bit of a vacuum here too. So, and what I mean by that is New England, the Northeast, we've got all this, we're in a big metro area, right? We're a smaller suburb, a smaller city. Hartford, we'll call it a tertiary city, like a third-rate city in size. No offense, Hartford. No. It's not that you're third rate, we're just in size. But you've got New York and Boston, right, within 2 hours, we'll say, of our any major point in Connecticut. And what's happening is major cities start to see the downturn a lot later. So when you really want to judge what's coming, you can watch it kind of sweeping across the country. Starts in Florida, historically, and it's happening right now. If you go to Florida right now on Zillow, grab Miami, grab
Tampa.
I mean, there was a crazy one I've been watching, Cape Coral. These are areas that historically had not a lot of houses for sale. It looks like an outbreak map now. It is, everything's for sale.
Yeah.
Florida has its own troubles with flood issues and flood insurance premiums and insurance killing us right now.
Oh, yeah.
I think you had a guest that was here that I actually saw. I paid attention to your podcast.
Good for you. Good for you. As you should.
Yes. AAA, is that where she was from?
Yeah.
So, that we're seeing the spread start. Vegas, Austin, those areas, Texas, Arizona, we don't have tract homes like they have out there. When they build a big development, they're building hundreds, thousands of homes. We get something in South Windsor, hypothetically, where it's 8 homes. That's like big news, right? I know. We just don't have the lands, but we're seeing it really slow out there. Like all of a sudden, people are renegotiating. Builders are having to incentivize. You're feeling it now. So that sweep, though, usually takes a year or so to get to us. So there is an inventory coming. There is change coming. And I think 24, if we buckle down and do the right thing, we'll be good. We'll be good.
Yeah. I definitely think right now, like you said, it's weeding out. We talked about this off camera. It's weeding out the people in our field that expect things to come to them.
Yes.
You have to have some type of skill right now. That's what I'm seeing. And those are the people that's winning right now.
Yeah, we have a saying in the mortgage industry right now: survive till 25.
Survive to 25.
That's the, like, everybody's trying to come up with catchy jingles. It's been survive till 25.
Right.
Meaning, for us, it's get back to basics, which is what we're doing. Right. This.
Right.
Go sit in front. Go see your peers. Go talk about what's happening.
Right.
I have 2 types of loan officers. Right. I have loan officers that are coming in, and like I'm assuming it's the same in the real estate world. Everything's bad and it's not like it was 2 years ago, and I've heard everything. And then I have my top producers who come in, and the only difference is, like, can you believe it? It's amazing. Like, I'm getting to meet all these people that I normally wouldn't be able to talk to. With a whole different mindset. Where it's like, and I'm like, one guy's over here like Eeyore, like doom and gloom, and the other one is coming in and going, how wonderful this all is. Jason sat down with me, and I'm in this great office.
Right.
It's just, when it's easy to lose sight. Right. That's what I always tell everybody. If it's coming to you, That's when we get comfortable, right? That's the danger zone.
Right. We talk about it.
Now it's just, it's wake up time.
It's wake up time. It's go time. It's go everyday time.
Yeah.
I was, again, just talking about how much I work. I put in 16 hours a day. 6 in the morning till about 10 o'clock at night, right? And people ask me, they call me crazy. Do you really want to work that way, that much? I absolutely love what I do. I don't mind. I don't feel like I'm working. It's like a game to me. Right? It's like literally life Monopoly, But now, if you aren't working, not like that many hours, but if you're not working, you're losing.
Yeah, you are.
You're losing.
And I don't think I've ever worked so hard for so little right now, right? Does that make sense? Like I feel like we're putting in more time and energy and I think that's the frustrating part for a lot of people in the industry right now. Even the home buyer, to bring it circle back to the home buyer, how frustrated they must be right now, where they're out, trying to find a home, doing all the right things. All of a sudden rates are up. They don't qualify for as much. They don't. And I try to put myself in their shoes because it seemed so easy 24 months ago.
It was.
It's cyclical. It'll pass, and I think if you stay positive, I mean, you guys. I mean, I gotta tell you, I'll give you guys your accolades. I mean, this was like a breath of fresh air walking through the door of this company. I haven't seen anybody this excited in the last 2 years. Like, I want to come hang out here, and it's so positive.
I'm happy I got you. It is. And I'll tell you what. So please introduce yourself. Let us know your name, your company, where they can find you at, phone number.
Yeah, so
all that stuff.
We're CMG, and I said in the beginning, we're one of the largest lenders nationally. My personal office, where I am with some of the staff, is out of South Windsor. We serve all of Connecticut. I've got offices in Danbury and Middletown. I have an office in Massachusetts, Rhode Island.
Okay.
You do. Yeah, we do.
Right.
Yeah, we're licensed in all 50 states. So another cool thing is, if you got people relocating, you want to throw referrals. We can always take your clients across the country.
That's powerful.
My website is readysetloan.com.
Okay. Ready Set Loan.
Yeah, www.readysetloan.com. And we're always available.
It was good having you, man.
Thanks, man.
Yes,
this is really cool.
This
is really cool.
So again, this is Neil Caron, CMG Mortgage. I'm J.G. Kemp, your host, and we will talk to you soon.